In this video, I'll explain exactly what happened during the volatile short squeeze involving GameStop stock. And we're starting right now. Hey guys, welcome to another video from the Keystone Financial Academy. My name is Elliot, and if you're new to this channel, I invite you to join our community by subscribing and turning on notifications so you don't miss any of the upcoming videos. If you are anywhere near your phone, computer, television, or radio in the last week of January 2021, you couldn't escape the barrage of news reports concerning GameStop, Robinhood, Reddit, and the short squeeze of some hedge fund that you probably never heard of until now. This was breathlessly reported as some sort of populist financial revolt and a major manipulation of company stock, if not the stock market itself. So what exactly happened and why is this such a big deal? In this video, I will explain exactly what transpired because it truly was a fascinating and outrageous Wall Street event that will have repercussions and be analyzed for some time to come. So here, in plain English, is an overview of what happened with an introduction of the key players and some definitions. First off, for those who don't know, what exactly is GameStop? It's an American video game and consumer electronics company based in Dallas, Texas, and appearing in its current form since about 1999. The company has been in a decline in recent years, which is an important point to our story. And this is mostly due to gamers and consumers in general switching to online purchasing as opposed to storefront, paired with a few failed investments on the part of the company's management. Next, we need to introduce Reddit.com. The site is fairly well known, but for those who haven't ventured onto its pages, it's essentially a social news aggregation and discussion site, a forum if you will, where registered members submit content on a variety of topics via subject categories called subreddits. The site's been around since about 2005 and is well recognized for its almost anything goes discussion topics, and the moderators usually have their hands full keeping the site more or less orderly. The third player in the story is Robinhood, the free online app that allows you to place trades to buy and sell stock as well as use other financial instruments. Robinhood is of course not the only online discount broker out there, but it's well known for never charging any fees to trade, and its business model had a major impact on other brokers who also had to stop charging fees in order to compete. Robinhood is credited with bringing online stock trading to even more people that have never been exposed to it and is very popular with the younger crowd. The fourth and final player in this story is a hedge fund called Melvin Capital Management. Founded in New York City in 2014 by Gabriel Plotkin, it was notable for notching up some impressive returns since its inception, as well as having an intense focus on short selling as part of its investment strategy. This of course brings us to a key concept that ties all our players together in our story, and that is the concept of short selling. When an investor shorts a stock, they're essentially placing a bet that the stock will decline rather than rise in value, which is the opposite of how most people typically invest. This is of course a speculative technique and one that's not without quite a bit of controversy, as short sellers are essentially hoping for failure, not success. So how is short selling done? In practice, it's actually not that complicated. In order to short sell, an investor opens a position with borrowed stock in the company that he wants to short. This is done with a broker-dealer using borrowed funds in a margin account, with margin just another name for a line of credit that the broker-dealer extends to the investor. Then, if the investor is correct and the stock does actually decline in value, they will buy it back at the lower price and hopefully make a nice profit once any fees and interest on the borrowed money is paid back. The term short in the word shorting comes from the fact that investors are selling something that's borrowed, something they did not own, making them short by the amount sold. Because shorting is so important to our story here, let's do a quick example to illustrate it. Let's say an investor borrows 100 shares from their broker-dealer, each worth $75, and then sells them on the open market. If the shares go down a few days later to say $50 on some bad corporate news, shares, the investor will close out their position by buying back these 100 shares at the new price to replace the ones that were borrowed. The short sale profit will be $25 per share. That's the $75 minus $50 times the amount of shares, 100, which equals $2,500. Now, the broker-dealer hadn't paid for these shares initially. They were just sitting there waiting to be sold. But once borrowed, they have to be replaced at whatever the final sale value is at that time. The investor initially sold all 100 shares for $7,500, that's 100 shares times $75 each, and bought them back for $5,000, that's 100 shares times $50 each, pocketing the $2,500 and replacing the missing shares with the remaining $5,000. This all works great if the price declines as predicted. But, and this is extremely critical, the investor can lose a lot of money if the stock heads in the opposite direction, in this case up. If the share price in the above example jumps to $100 from $75 instead of dropping to $50, the investor will lose $2,500, not gain it. What makes shorting even more dangerous for your wallet is that when a security falls in price, the most it can fall to is zero. Thereby, your shorting profits, while substantial, are finite. However, in theory at least, share price can rise without a limit. And therefore, there's virtually no limit to your short selling loss, as Melvin Capital Management was about to find out. Okay, so now you know all the major players and you have a good understanding of what shorting stocks are all about, and we can get back to our story. And here's where things get really crazy. What happened was that there was a large number of users on reddit.com congregating in a subreddit called Wall Street Bets, caught wind of the fact that Melvin Capital and other hedge funds were shorting GameStop as well as other failing companies like AMC, BlackBerry, and Bed Bath & Beyond. They then singled out Melvin Capital and GameStop, perhaps feeling kinship with a gaming company in trouble, and began to buy up its shares to fight back against a massive hedge fund. To increase their leverage, everyone used options to control a very large amount of stock rather cheaply. These options were largely bought on Robinhood, but other brokers also saw an uptick in activity on GameStop stock. This well-coordinated buying by thousands of Reddit followers had a profound effect on GameStop. Its shares rocketed from a lowly $20 per share all the way up to nearly $500 on January 28th, and then settled down a little bit lower after that. Now, obviously, GameStop's fundamentals did not support such a high valuation, and truthfully, no one really cared about saving GameStop, but rather they wanted to stick it to a powerful hedge fund and make money at their expense. And boy, did the Reddit crowd stick it to Melvin Capital. As I just described earlier, a sharp rise in share price is disastrous for a short seller who's hoping for price decline. As the GameStop shares rose in value, Melvin Capital tried to close out their position by buying up more stock to cover their losses. This in turn caused the price to go up even more, creating a vicious circle where more stock buying was needed to cover mounting losses, but the very action of buying made the losses even worse by pushing the stock price even higher. When all was said and done, just a day later, the hedge fund lost nearly 30% of its value, amounting to about $3 billion, although the actual loss was probably much higher, and Melvin Capital was forced to apply for emergency credit to stay solvent. This was a classic short squeeze played out in real time for all the world to see. Now, what is unique here is not so much the shorting. That is actually done quite often on Wall Street, both by individual and institutional investors. Short squeezes are also not unique, and companies being shorted often fight the short sellers by repurchasing their own stock, making acquisitions, increasing dividends, or just becoming more profitable, all of which will send short sellers running for cover. What is different here is the speed and aggressiveness with which all of this was done, and also who was doing it. This is the first documented case of regular dollar investors being organized on social media and nearly taking down a hedge fund. This was financial populism in its most basic form, and a testament to the dangers of small-time, seemingly powerless individual investors when organized into a major force by social media. So this is how it was done. The bigger question to ask is why? If saving GameStop was not the goal, then what was? Sticking it to the hedge fund was certainly a motivator for some, but it wasn't enough to mobilize that many people. The real motivator here was money, specifically the transfer of massive amounts of money from the perceived big bad hedge fund to the little guy. That the financial counterattack was done mostly on an app called Robinhood just adds to the irony. And indeed, a massive amount of money was transferred. Buyers of GameStop stock who monitored the action closely and sold the shares as the price peaked out walked away with tens, sometimes hundreds of thousands of dollars of what was essentially Melvin Capital's cash. But ironically, it wasn't only the little guy who profited. The fund BlackRock, one of the biggest around, got a $2.5 billion windfall as a result of their 13% stake in GameStop. In the days since the stock peaked out at nearly $500, stories began to emerge of ordinary minimum wage workers cashing in the inflated GameStop stocks and paying off car loans, student loans, and credit cards. So was all of this legal and right? Well, legal, yes. This is how the financial system works, and short sellers know or should know the risks involved. And banding together online to buy up stock in a company is not technically illegal. Was it right is a whole other story. There was certainly a feeling that when the big players do some questionable financial transactions, they tend to get away with it, and this was the little guy's turn to get even. This blew up in a big way for the Robinhood app when they tried to limit the buying and selling of GameStop stock right at the peak of the volatility. They were then accused of hampering the regular Joe investor while the big players were still able to buy and sell via other means. As of this video, Robinhood is facing a number of class action lawsuits, and politicians on both sides of the aisle are promising to look at this whole affair from top to bottom. So this in essence is what transpired during the week of January 25th to January 29th. The story is still playing out, but the short squeeze will likely run its course and taper out. There have been a lot of copycat attempts around the world to squeeze other short sellers, and it's likely this event will lead to changes in how short sellers approach what they do. And possibly some new regulations may come out of this. We'll just have to wait and see. What is for sure is that people have found the new collective power to take on the titans of Wall Street, and that in the end is the new profound change in business as usual. I really hope you enjoyed learning about some of the crazy events that transpired in the last week or so, and if you did, please consider subscribing and hit that like button. Thanks for watching, and I will see you all soon.